Putting your emergency fund in the wrong place will quickly erode the value of your money due to inflation. So in this video, I'm going to be sharing with you 3 key criteria to evaluate when considering where to put your money and the 4 best options of places to keep your money, and the last one is the most unique. There are 3 key things that you should be looking at when considering where to put your emergency fund, and those are security, availability, and interest rates. So let's dig into each of those a little bit more. First up is security. So the security of your account options matters a lot. And whatever bank or credit unions that you are considering for places to save your money, make sure that the institution is FDIC insured. This protects your deposits up to $250,000. And on top of FDIC insurance, you don't just want to put your money at any institution that you see. Without naming any names, you really want to consider the reputation of the financial institutions that you are considering so that you are ensured that you are making a good choice. The next thing you want to look for is accessibility. So one of the key things when having an emergency fund is having the ability to access that money when the need arises. You really don't want to be dealing with an emergency situation and then also trying to figure out how to get your money out from the place that you've put it. So you want to make sure that you can access your money really quickly without having to jump over a lot of unnecessary hurdles. And last but not least, interest rates. So you really want to make sure that you are getting a competitive interest rate, because that interest rate is what will give you that little extra boost so that you can meet your emergency fund savings goals even faster. So you'll want to do your research and compare rates to make sure that you are getting the best rate possible. Now let's discuss options of where to keep your emergency fund. The first option is a high yield savings account. And if you have watched a couple videos on my channel, you will know that I talk about this account type a lot because it is so great, and I think everybody should know about this account. And I think it's still not that widely known. So if you don't know what this account is, essentially a high yield savings account is a savings account that offers higher interest rates than your traditional bank savings accounts. And these rates can be as high as 20 times the national average traditional savings account rate. High yield savings accounts are typically offered by online banks, and because they have lower overhead and operational fees, they're able to pass on that savings to you, the customer, through higher interest rates. And as I mentioned earlier, these higher rates are so awesome because they will help you to build your savings even faster. High yield savings accounts check off all 3 criteria that we talked about earlier. In addition to the great interest rates, many of the banks that offer high yield savings accounts like Ally, Wealthfront, SoFi, etc., they are all FDIC insured, so you don't have to worry about your deposits. Additionally, these banks typically offer really quick transfers, typically within a couple of days, so you don't have to have any type of concerns about transferring your money and pulling your money out of your emergency fund if the need arises. The next account type you should consider is called the money market account. So similar to a high yield savings account, money market accounts tend to offer higher interest rates compared to traditional savings accounts. The reason that they are able to offer these rates is because your bank or credit union takes the money that you deposit into your money market account and they loan out short-term loans to other banks, government, or corporation. And then when your bank gets repaid, they get interest on that. Then in turn for letting your bank use your money, your bank repays you interest. These short-term loans are part of what's called the money market, where money is accessible almost like cash. Money market accounts really offer a best of both worlds blend between a savings account and a checking account because they do provide that extra interest earnings while also offering you accessibility to your money. Many money market accounts come with check writing privileges and debit card access, which makes it really easy to make purchases and withdraw money directly from your account. But something that you should keep in mind is that many money market accounts do limit the amount of times that you can withdraw from that account. It varies from institution to institution, but typically the limit is about 6 times per month. One of the most notable and unique features of money market accounts is their tiered interest rate structure, which means that the higher the balance you maintain, the more interest you can earn. However, money market accounts do typically tend to require a higher minimum balance compared to many traditional savings accounts, which might be a barrier for you. So that's something that you should look into and research at the institutions that you are considering. Money market accounts are FDIC insured, which helps with your peace of mind. So once again, all three criteria of safety, accessibility, and interest rates are satisfied in this account. The next option is a certificate of deposit. So a certificate of deposit, or a CD, is a time deposit offered by banks which give you a fixed interest rate for a specified term, and this term can range anywhere from just a few months to several years. CDs typically offer higher interest rates than both savings accounts and money market accounts because you do agree to leave your money in there for a set period of time. And if you are to withdraw your money early, you will have to pay penalties. CDs are a great option if there is a certain part of your emergency fund that you don't anticipate needing access to right away. So for example, if you have a $10,000 emergency fund, maybe you could consider putting $2,000 away in a CD if you think that you won't need that. And that way you can earn that extra interest on the $2,000 while still having access to the $8,000 in a different type of account. To really balance the desire between accessibility and also having higher returns, one thing you could consider doing is a CD ladder strategy. This strategy involves dividing your emergency fund into several different CDs. For example, you could have a 1-year, 2-year, and 3-year CD. As each CD matures, you can either use those funds if you need to for some emergency situation or reinvest them into another CD. So this strategy will allow you to still have some periodic access to your funds once each one matures while still earning that higher interest rate. CDs are FDIC insured, but as we've talked about, they aren't highly accessible if you have a major emergency, so you wouldn't want to have this as your main strategy for your emergency fund, but they do provide those great interest rates which can really help boost your savings. The next option is quite unique, and I don't hear a lot of people talking about this, and that is Treasury Bills. Treasury Bills, or T-bills, are short-term government securities that have a maturity of 1 year or less, which makes them a very safe and liquid place to put your emergency fund. T-bills are issued at a discount rate for their face value, meaning that you purchase them for less than their maturity value, but at maturity you do receive that full amount. That discount represents the interest that you are earning on the investment. T-bills are backed by the full faith and credit of the US government, making them one of the safest places to park your emergency fund. Purchasing T-bills is really easy. You can do it through the US government Treasury Direct website, or you could use a broker. T-bills are available in various denominations. They start at $100 and build up from there, so it really does make it accessible to pretty much anybody, no matter if you're just starting off with your emergency fund or you have already built up quite a lot of money. The short maturity periods of the T-bills ensures that your money isn't tied up for too long, and you can either reinvest your proceeds or you can have access to use that money if you need to. The liquidity combined with the stability makes T-bills a really safe option for your emergency fund, but I will say that the returns on T-bills tend to be more modest compared to other investment options. However, if security of your money and availability are huge priorities to you, then T-bills are something that you should definitely look into. I do have an entire video where I go into more depth on T-bills that I will leave linked in the description box of this video if you want to check that out for more. Leave a comment down below and let me know where you are currently keeping your emergency fund or where you are considering keeping it. And don't forget to subscribe to my channel for more personal finance videos.